Hello. All right. Quite some of you are still missing. You think they're not going to join or what? Right. Okay. Well, let's keep that open. So you've had 2 lectures with Greg. Well, what I would say is that you can see that the lectures are quite intense. I don't know whether that was your feeling or not, but it's clear to me that if you can tell your friends that it's important that they come to the lectures. Otherwise, my interest in the end, or our interest, is that all of you pass nicely, etc. But that requires that you're there. Otherwise, you won't get it. And learning from the books or from the lectures at home is not the same as being interactive. So nothing against you who were there, but just tell your friends it's important. The second thing is that we are going to have, I believe that the coursework is going to start, you'll have it next week, if I'm not mistaken. I have, for you to feel relaxed, I've accepted, I don't know the detail of the groups and things like that, but I've suggested that we have flexibility here so that it is something that is being done easily and nicely by all of you. So you've had, my first lecture, which was about questioning the existing common knowledge, basically. Then you've had 2 lectures of introduction to behavioral finance with Greg, one more general and then one looking more into features related to investors. What I'm going to do today is to, in fact, revisit what you've seen up to now in terms of portfolio construction. That is the CAPM, Black Litterman and things like that, and try to explain why, what are the weaknesses of these, getting into the details of the elements to pave the way for some reconstruction in terms of what do we do and how do we do that. Now, one of the things I'd like to say is that you're going to have the coursework next week, I believe. You may not have basically the coursework is the type of information that is important to have is related to lecture 6. So it is the lecture on risk premia and things like that. This is the reason why, and we may not be on lecture 6 next time. So this is the reason why I need to check where we are. I'm not completely certain. This is the reason why I've been more flexible on the size of the teams and things like that, so that even if you haven't got an awful lot of time, then there are more of you. In addition to that, if there is more time that is required, another week or things like that, we can manage, okay, so that it's flexible. Okay, so sorry, this is called lecture 3, and last time was lecture 4 probably. I haven't changed because Greg and I changed the ordering this time. So what we're going to do, in fact, is first thing is a review of mean variance, CAPM and things like that, like I said. And then we are going to try and understand practically with some tests why the approach doesn't yield to performance. So the first thing that I suggest we do is we take a portfolio of asset classes, quite traditional asset classes, bonds, equities, commodities, real estate and hedge funds, and some cash. We take that including the 2008 crisis. So this is the most important thing in order to understand the impact of a crisis. And here are the type of results that we have. In terms of return and volatility. Typically, one question for you: why do we consider excess return rather than here? When I say excess return rather than return, why do I do that? Any idea? No? Yeah, because when you look at a return, here what you tend to have is different regions or different currency involved, okay? So you've got some related to the US, some outside of the US, like the MSCI emerging market, which is, well, maybe quite tilted to the US, but the MSCI World ex-US is actually the developed countries ex-US, so it's quite a lot of Europe and developed Asia, according to the MSCI categorization. But in fact, the interest rate in these various currencies are not the same. So actually, when you look at the return is not going to be the same in a country where you have got an interest rate of, say, 5%, and in another country where you've got an interest rate of 0%. So in order to have something that is comparable, you need to retrieve the risk-free rate that may be different from one country to another. So in order to ensure comparability, we will work on excess return and not on total return. Okay? So now looking at this, you can see that there are some significant differences in terms of volatility over the period under study, and also in terms of returns. It is presenting, if I look at the curve here, which is giving the volatility, the annualized volatility versus the annualized historical return. So what you have is you've got something that is expected, which is the more basically some sort of an upward trending curve, which means that the more risk you take, and if you take risk as volatility, which is not sufficient, we agree, in fact, you being remunerated for the risk you're taking by having a level of return that is going higher. And then there is something that is interesting, which is that over the period here, when you take a fund of hedge fund, you're getting a better pay than with bonds. But obviously, when you take a fund of hedge fund, what you have is you've got a level of embedded risk of illiquidity and things like that that you may not have with bonds. Okay, so the risk may not show up in terms of volatility, but it doesn't mean that there is only, there may be more non-statistical risks that are being involved here. In terms of correlation over the period, what you have here is, it's just for the sake of understanding, is the fact that you have basically one of the things that is interesting, people tend to think of decorrelation. You have some asset classes like fund of hedge fund having quite a high degree of correlation between with US equities, 0.48 and 0.45, or emerging market equities, 0.65. So what you can see is that you still have the bond equity divide where historically the bonds are quite decorrelated from equities. This is something that is important. When you look at the equities here, you'll have them in this region. You find levels which are levels of 63, 66, etc., etc. So you can see something that we discussed already, which is the fact that the volatility or the covariance between the equities is non-negligible. Okay, so this is it here. Now, what do we do when we go for the traditional portfolio construction? Well, the assumption is, in fact, there is one thing to see, which is at the time Markowitz came with these ideas, in fact, the number of markets where there was liquidity was fairly limited because basically it was US equities and US bonds. Okay, hedge funds in the 50s didn't exist. Liquid real estate didn't exist. Commodities didn't exist to the same extent. So it was reasonably well-behaved asset classes close to Gaussian. And in addition to that, the other point is that they were computers were almost inexistent. So one of the challenges of everybody was to find some sort of closed-form solutions which was easily tractable. So looking at the quadratic utility function for him was considered on the basis of ease of use rather than on the basis of does it make real sense or not. And so what happened here is that the mean variance utility is being expressed as a function of the excess return and the variance, with in fact a penalty term for the variance, which means that in case you've got a high variance, then what your benefit, your preferences or your benefit is in fact diminished by this high level of variance. So you're not experiencing, in fact, the benefit of the return or the excess return. You're experiencing the benefit of the excess return minus a variance term. And one of the things is that, in fact, the A here is a parameter that is defined generally, and A is something that depends on the investors. On the investor, that means that if I have a high degree of risk aversion, then A is going to be high. If I've got a low degree of risk aversion, A is going to be small. The interesting thing with this setup, and here comes the tractability, is that the sum of two Gaussians is a Gaussian. So what it means is that when, as an investor, I have assigned me another investor, that means that, in fact, the two of us together are also going to be, in fact, a Gaussian investor, so dealt with a quadratic utility function. That is that if I consider normally the risk aversion factor is specific to one investor, but in fact I can back out the A star, which will correspond to the risk aversion of the community of investors. Okay, so from a tractability perspective, it is fairly easy to use this. So in fact, what happens here is that the question I'm asking myself is that if I have weights in a portfolio that are characterized by a vector x, the question is, what are the optimal weights given what I know on each of these assets in terms of excess return, excess expected return, and unexpected volatility? Okay? So in order to do that, nothing particular here. What I'm trying to back out is back out the x, given the fact that I want to maximize this. And this has got a unique solution because it is a convex problem. And the convexity means that there is one optimum level. So if I take the first derivative, and that I take the first derivative of this, and I equal it to 0, I'm certain to find the maximum here. And it's a simple tractable problem. Okay? So again, ease of use is what has been driving this, and the existence of easy solution. As a result of that, what I have is I can back out the x, which is going to be, in fact, depending on the mu, which is the returns. It's going to be depending on the risk aversion, and it's going to depend also on the inverted covariance matrix. So this, by the way, this corresponds to a problem in the sense that when you have got quite correlated assets, the inverse of the covariance matrix is going to have very limited, very small numbers. Okay, so the more some assets are correlated, the weaker this is in terms of weight, because the weaker what we're going to find in terms of inverted covariance matrix is going to be. The less robust it is going to be. Okay, so actually this shows one thing that, and here I'm not in a criticism mode, I'm just in a descriptive mode. One of the things that is important here is that in order to build a portfolio, a diversified portfolio or an optimal portfolio, the first thing that needs to be done is to select assets that are quite different from each other. Otherwise, the inversion of the covariance matrix is not going to work properly. Okay? And to be frank, with the fact that, like we saw on the first lecture, that the convergence between the various equity per region, etc., is increasing, that is posing a problem. So if I have, for instance, if I'm looking at the US small cap versus the US large cap as part of the university in order to make a decision according to this approach, probably I'll find a degree of correlation that is very high, a degree of beta to each other is going to be very high. As a result of that, the inverted covariance matrix is going to be very weak. Right. So this is what you've seen. Now, one of the things is that, obviously, because we're doing that on the basis of excess return, the side effect of this is that cash as an asset doesn't exist. Because, in fact, what I'm looking, the excess return of cash is zero. The excess volatility of cash is zero. So cash from this, in the optimization process, doesn't seem to exist. But in fact, it is not completely true. And so I'm going to have a look at 3 different options. One is including into the portfolio a risk-free asset. Another one is without the risk-free asset. And the last one is with additional constraint. Why do you think that having some cash or no cash is actually making an impact in the portfolio? The optimization process, according to what we have said, will not change. Okay, it will be just the same. But it makes a difference in terms of allocation. Why? Well, in fact, in terms of weighting, it's going to make a difference. So I can select the same optimal portfolio. But in one case, I'm better off than in the other, and why? So, what it means. So right now, I'm just looking at the optimization. My preferences are, I'm just looking at the optimization across the assets. So there is, in fact, one solution right now, okay? Which is, I'm looking to optimize this, and I'm looking to find the optimal portfolio, the optimal weighting, X. And now, as a result of that, in fact, I've done that all on excess return. So no cash, but cash comes to play after all. And I'd like to get a feel. Why for? And I'll tell you. Because in fact, as an investor, I may have an objective in terms of volatility that differs from the optimal portfolio. And in order but the optimal portfolio is the best trade-off I can achieve if I believe in the model. So in order to find the level of risk I'm interested in, what I can do when I've got cash is to deleverage or leverage the portfolio. Okay? So as a result of that, keep the same optimal blend with or without some cash. So either pouring in some cash or leveraging in order to have something with a higher octane of risk. If cash does not exist, then as a result of that, I am constrained because I cannot leverage or deleverage. To control the level of volatility I'm hoping for. So in fact here,
if you prefer more volatility, you borrow, you leverage it, and then if you prefer less volatility, then you...
Exactly. So in fact here, what I have is I've got the same asset classes I had, okay? So here you can see that I have got the optimal portfolio, which is going to be the maximum Sharpe ratio, which is, and all this portfolio here are going to be, when I've got cash, leveraging or deleveraging this one, providing the highest level of risk-return performance. While if I don't have this one, I'll have to be on the efficient frontier or something like that, which is going to be taking, if I am on this one, which is the constrained one, I'm long only everybody. As a result of that, I have to be supported by the best performing assets. If I allow for some shorts, I have got some shorts in terms of asset classes. I am able to do a bit better than this maximally constrained efficient frontier. If I've got cash in addition, then I can decide to leverage or deleverage the portfolio. Okay? Is everything okay? Right, okay. We're going to go through it, okay? Through that. But so basically what it means is that if I look at this here, is with a risk-free asset, I can have some long-short position, I can have some cash, etc., etc. As a result of that, I have, I keep the equivalent performance performance whatever the level of volatility I want, which is equivalent to the Sharpe ratio. And everything is available. And the only thing, basically the only thing that will vary for two investors is going to be the risk aversion. Here, what happens is that without risk-free, I can have some long-short position, while in fact when I'm the most constrained is with a long-only positions for each of the assets. So it's what I said. So you can see that there are, if the understanding of the excess return, the volatility, and the covariance matrix is right, you can see that there are big differences in terms of allocation. Why? Because here, if you look at this one, okay, the maximum Sharpe ratio here, it is at the beginning of the curve. So it's going to be heavily loaded with hedge funds with a few assets. And what I'm going to do with this one, I'm going to concentrate my bets and then leverage that, so by borrowing against that. So the number of assets here are going to be fairly limited because I'm not going to use the emerging market equity assets because these guys have got a Sharpe ratio which is lower than this one. So I'm going to take basically the maximum Sharpe here related to all of this, which is going to be made of a few assets, and this is it. While in here, if I want to be here on this efficient frontier here, I'll have to have a blend using several of these assets, so having emerging market equity, having real estate, having fund of hedge fund, etc., etc. So the more I'm using long shorts, the more I'm using cash, the more I'm increasing the level of certainty in terms of what is going to be the outcome of the future returns of the assets. And of course, because I'm taking leverage, my funds are expected to deliver more in terms of return, but it's assuming that all of this construct is working well. Okay? So it's not obvious in the end, ex post, that this portfolio is going to underperform that portfolio or the other portfolio, given the degree of concentration or certainty that each of these involve. Now, what I have done here is I have done something purely based on my expected returns and my expected volatility, or the covariance matrix. If you and I, and this is something that we discussed last time, if I am using 10 years of history thinking that there is going to be some sort of through the cycle excess return, excess expected return, or excess volatility, you may decide that in fact it is not 10 years, it's 15 years. Another person may decide 5 years, on 5 years and things like that. So everybody will have a different view, okay? And this is one of the difficulty, which is that it's hard. The mechanics of all of this is super simple. But whether it is right or wrong is very difficult to assess, because in fact, there is no way to say that it's proper best-in-class techniques to use that amount of data or another amount of data. Okay? So here is the idea with the CAPM, which is that in order to have, it is introducing, instead of having a pure microeconomic perspective, which is looking at each investor, it is looking at a macroeconomic perspective to say if people are making rational decisions, then in the end, there should be some link between what there is in the market in terms of available assets and what there is in terms of aspiration from the people. Because in fact, offer and demand needs to stack up. Okay, so this is the idea behind the CAPM, which is the fact that supply and demand for each individual asset should reach an equilibrium return, an equilibrium level. And that from this equilibrium level, in fact, what we should be able is to back out, in fact, the expected return in the market. Because one thing is, suppose that people think that one asset is much preferable than other assets. Okay? It's very unlikely, the intuition was this, it's very unlikely to have the preferable asset underinvested. Basically, normally what should happen is that the preferable asset is going to be growing to the point where the marginal level of return it offers is equal to the others. Okay? So in fact, you can't have a vastly preferable asset which occupies a size in the market that is fairly limited. Okay? You got the same on your... is it the same you've got here? Okay.
Previous slides also don't work. They're formulas.
All right. Okay, so this must be a problem. It's a PDF that you have? Okay, because what I did is I sent them the PowerPoint. So what I'm going to do is to make sure that you're being sent the PowerPoint, so that it is in fact, because it's a problem of printing of the formula. So it's something I'm going to do. So let's see practically. Let's see practically how it works. Trying